Let's get in some more reactions. Omkar Tanksale is now joining in. Omkar, will these numbers from TCS allay any worries that the street had about slowing demand?
Yes, I mean definitely, but I believe the TCS has reported largely in line results with the street expectations. The only concern about me is the additional level we were expecting some at present down at some level, which are not being still rising at 1.5 for the quarter. That shows that there is still volatility going up, but I think on the demonstration part or execution part, they have demonstrated well with the margin expansion of 3 basis points for the quarter, which is ahead of our expectations. Demonstrating a strong execution force. I think we should be listen to the commentary from the management. However, the management are still very bullish on the spendings from the large client accounts currently, but like to be have the words on what the commentary is going ahead.
Prakash, what did you make of the statements from the TCS top management?
No, I think all three versions of the input or insight into this earnings are very positive, and of course it might not be as bullish as the what Rajesh Gopinathan sounded in the same quarter of 2020 when things actually took off from where the stock actually rallied so hard. But what's interesting is, since you were talking with the internals after we spoke in the first reaction, if attrition at 21.5% can probably be the peak, and why I say that is because they're hiring the sub 10,000 number very clearly gives you an idea that probably they're anticipating attrition to only taper off from here. And if that were to happen, you already have a constant currency growth which is phenomenal in the current environment, the volatile environment that you see. The margins getting retained, and their focus on margins that NGS is talking about is so positive for the simple reason that they probably amongst the big players, they have reached a scale which they don't need to be worried about in terms of market share gains and this thing. And some of the new projects that they have undertaken, it could be small ones like the BSNL revival and all of those are great learning experiences. So my sense is this is probably a change, a shift in gears for TCS in a territory or in an environment which was tougher, and they'll probably not only be resilient to all the vagaries of the slowdown that is anticipated, but they'll probably strike out the perfect balance in terms of growth and margin. So I think from that perspective, the stock offers great opportunities. This earning just endorses the fact that good companies always come back, right, in tough times. So this actually reflects that, and the statements validate that view if you had. So my expectation is that things could only look up from here, given that some of those worrisome parameters in terms of cost and attrition are probably peaking out and are behind us.
Well, the question is, will it convince the bears on the street who believe that FY23 numbers are going to look steady and strong because it's a reflection of the deals won in the prior quarter? But come January, the budgets for next year are going to be set, and at that time, we are likely to see some tech budget cuts. Given the recessionary environment in developed economies, a lot of clients, enterprises have been hit on account of inflation as well as slowdown. So tech budgets could get hit, which will then result in slower revenue growth in the subsequent years. So these numbers are good, but will it convince the bears on the street that I guess over the medium term we will have some clarity as well as from the management when they address the press conference at 5:30 p.m. Moshe Khatri is also with us from Wedbush. Moshe, thank you very much. What would be your top 3 takeaways from TCS's earnings this time?
Hey, good to be here. So I would say better than feared numbers. I would say that demand continues to be solid despite the macro volatility, and that was kind of expected based on the recent surveys that we've been conducting. And then third, I pretty much concur with your opinion, Rima, that it's less about the quarter and it's more about budgets for next year. So I don't know if budgets are going to be cut next year, but I think you'll probably see some sort of a slippage in budgets, which means that rather than budgets being ready by, I don't know, sometime in January, maybe you'll get a slippage by a month or two. which means that you're probably going to get a back-end loaded year in terms of revenue contributions for the sector. But so far so good. Budgets are already set for this year, so we're assuming numbers will track in line with expectations. But the real question continues to be calendar 23 budgets.
Absolutely. Moshe, deal wins at $8.1 billion, similar to the deal wins of the prior quarter and within the company's guided band of $7 to $9 billion. Would the deal wins already start reflecting if the macros are deteriorating? Shouldn't that be read as a proxy for future growth? And if deal wins are holding up, that means perhaps the next year may not be as bad. How would you read the deal wins and its significance?
Deal wins can be a bit tricky, Rima, just because we don't know how much of the TCV is new logos versus renewals. So that's number one. Number two, the rule of thumb in our industry is that budgets are not engraved in stone. So, you can win a deal, but it doesn't mean that you can get funding for it next year. So I'm always kind of skeptic when I see the TCV numbers. It's always good to see kind of an uptick in terms of directionally where they are. More see on new logos versus renewals. I don't know if that means much.
Okay. Just one more word. How would you read the increase in headcount? At 9,840 increase, it's much lower than the quarterly increase that we had in FY22, which was about 25,000. There is a sharp drop-off. Either it means that the company anticipates a slowdown in demand, which is why they're going slow on, replenishing the bench as, attrition continues to remain high or make fresh hires, or it means that attrition they expect is going to drop off significantly and therefore they don't need to make these hires. How would you read this number of increase in headcount?
The word is flexibility. Accenture also had a smaller than expected hire number for the quarter. And you'll see many companies getting set up and getting ready for that potential slowdown that everybody's been worried about. You want to get that flexibility on your bench. You want to make sure that your costs are under control because of that macro. And if demand remains where it is, they can always go back and start rehiring. So I think the word is flexibility.
Okay, but the statements from Milind Lakha, the chief HR, has said, we believe our quarterly annualized attrition has peaked in Q2. This is the first time they put it out in a press conference, in the press release, saying that the quarterly attrition has peaked out in Q2 and it will start tapering down from this moment, while our compensation expectations of experienced professionals also moderate. So at least on the supply side, commentary in terms of attrition, in terms of perhaps what the wage bill is going to be as they hire laterals is also fairly moderate and positive from a margin point of view. The company categorically saying that attrition has peaked out. It will start reflecting and moderating from this point on. They had said it even in the prior quarter. They said that their quarterly LTD attrition will increase in Q2, and then come down in Q3 and Q4, but the management reiterating that. They're also saying compensation expectations of experienced professionals has moderated. So that's also an important indicator of what the wage hikes is going to be, or the compensation on the variable pay is going to be. Samir, one more word on margins, because Samir Seksaria, the CFO statements and margins do seem to indicate that the company is focusing a lot on margin improvement, right? On the supply side, things are improving. They've got operating leverage. They've got the support coming in from currency as well. Would you look to increase your EPS estimates, baking in higher margins than what you earlier anticipated, driving an EPS upgrade for TCS? Moshe?
Yes. So a couple of things about earnings and earnings power and leverage in the model. Rima, if you remember, during the last downturn, companies in the space exited the downturn with peak EBIT margins. And a lot of this has to do with cost control, with bench management, if you will. But ultimately, you're going to have to maintain a balance between how many people you want to retain on your bench versus the possibility that things will pick up after a downturn. So there's no doubt that these companies have leverage in their model. they can maintain and sustain margins even throughout a downturn, but you have to maintain that balance. Just because when demand picks up, you have to have the right capacity to be able to kind of go ahead and process the demand for the pipeline. So that's kind of where we are right now. You can manage the bench, you can manage margins, and there's no doubt about that. And look at the margin levels that a lot of the companies had, at the peak or when we exited the last downturn.
Okay, Moshe, thank you very much for your inputs and reacting to the TCS numbers. We also have got Omkar Tanksale with us. Omkar, we've got you in a bit of a scratchy line, but you've had more time to go through the TCS numbers. If you could provide us your insights. What stands out for you?
Yeah, I've my reading about the TCS numbers. The TCS has demonstrated the resilience of the business despite of the uncertainties going on. So and also shows a resilience. About $8 million deals that they have closed for this quarter. We were expecting around 8 to 8.5. There will be definitely a slowdown because of the uncertainties and slowdown in the world's largest economies. But I believe the slowdown must be at the growth momentum that they were picked by FY21 and FY22 currently. But I believe the business is still being resilient and will likely to demonstrate strong, continue to be demonstrated the growth in the forthcoming quarters. We also believe that the attrition level or the supply side constraint will likely to be managed because of the slowing down on the demand side, because of there is a large demand for the technical experts and coders and especially on the digital front, the cloud transformation vertical, like various services like HANA, data security, cyber security, etc. But likely to be settling down going ahead, which will benefit these companies to manage their employee costs and other operating costs as well. With the growing volumes, the company will likely to get a larger, the stability of the margin side going ahead.
Prakash, one final word. What's the read-through for the rest of the IT pack?
So, it's difficult to extrapolate what TCS ends up reporting to the rest of the pack because all of them are going through their own set of challenges. But, given the fact that the commentary on demand seems to be benign, I would believe that you'll probably not have ugly shocks in most of the earnings, maybe except for, some of them like HCL Tech, which probably are a bit more vulnerable given their mix of revenue. But other than that, I think most of them will end up doing much better. Given that, the execution of the order book for this particular year could go on unhindered, more or so for the next 2 quarters as well. So that anticipation is kind of building in. It'll be interesting to see as a read-through for other companies, especially the larger ones, which have been a bit more margin conscious, like Infosys and all, in terms of how they respond to attrition and the challenges on the supply side. So I think this will set a little bit of a expectation which is more positive than what we had, let's say, a week back from IT. And then there were some reports which actually pulled the whole house down. As a sector, there was so much of downgrades that it kind of got worrisome. But this looks like, it's probably not yet, a scenario of, tough times for the numbers at least to reflect, and hence the stock could get to live for another day and start bouncing back with some sort of buying coming in. And particularly for TCS, I think these numbers will definitely attract a little bit of comeback of sorts in terms of whatever FI outflows we've seen in the recent quarters.
Prakash, Omkar, Moshe, thank you very much for joining in. A quick wrap out of TCS's numbers. Well, TCS has delivered a good Q2 earnings. Constant currency revenue growth at 4.4%, higher than consensus expectations of about 3.5%. Margins expanding by 90 basis points, aided by operating leverage. Currency surpassing expectations. The bottom line, the profits for TCS have crossed the 10,000 mark for the first time ever. That too, growing by 10% is ahead of consensus expectations. A couple of the other important important internals, deal wins largely steady at $8.1 billion. So that's a positive. However, on the supply side, the net hiring for the company has come down to sub 10,000 and attrition has increased to more than 21%. The management commentary is fairly upbeat. They say that even though the clients are preparing for a challenging operating environment, the body language from TCS appears to be that they continue to be fairly confident about the relevance of their TCS's service. So in that context, they don't appear to be too perturbed. Samir Suksaria, the CFO of the company, is saying that their priority is on margins, and I think the hint is that margins could continue to expand from here on, while the HR head is talking about attrition having bottomed out or peaked out, in Q2. Well, it's a good set of earnings. So despite a difficult operating environment, TCS has not seen any business impact, and things in Q2 at least have been fairly rosy for the company. Thank you for watching this special coverage. We'll come back and get you, we'll get you the coverage from the TCS press conference as well.